Good evening and welcome to tonight's live webinar for member only, where we look at the ASX investment opportunities in review for the 7th of December. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service which is based around our algorithm model portfolios across the ASX 20, 50 and 100. Also have access to the US S&P 100, our ASX ASX and US high conviction. We also run an independent portfolio where we can work in partnership with you to execute specific ideas and use derivatives to enhance portfolio returns, which is especially useful in low volatility stocks like Woolworths, Coles, etc. to drive the extra yield return. So if you'd like to know more about the broking account service, please call me on 1300 614 002. The technology that we're using tonight is the member area. If you're trialing that and joining us for the first time, just as a reminder, you can subscribe to the service for $1,320 for the year. If you'd like to call the office at any time, I'm happy to walk you through the features and functions of the software and show you how to best get the value out of the technology. The chart up on screen is the NASDAQ. I always bring us back to this just as a reference point. We know that for the most part, the bulk of the market's under buy signals, and we've been really focusing on that long side of the market and taking advantage of the algorithm buy signals in the market. But we remain mindful that the PE ratios of the technology area of the market are stretched, and therefore there's risks to at some point a correction occurring, and therefore we bring the safety net up each time we see a new low within the up structure. We shift the safety net up, and a break below that, I'll draw your attention to that on the blog. For the moment, we'll take a look at the chart a little bit closer up in the moment, but we can see there that it's still making new highs, and we've just shuffled that support line up. But as we've discussed previously, with PE ratios at 70 times or 100 times multiples, we're at historic levels. And this is something that we've looked at in the past, and the reason why I'm going to pause and spend some time on this tonight before we get into reviewing the stocks is really this added section down the bottom here, and this is from CNBC. So this takes the earnings consensus estimates, which are effectively baked into the stock market valuations. These assumptions are what's driving valuations to be what they are today. So what that's saying is that 2020 earnings have fallen from $160, and again, if you're joining us for the first time, just to explain what we're looking at here, this is the average earnings of S&P 500 companies. So it was $162 of earnings per share in 2019, and it was the same in 2018. During the pandemic year, we've seen this drop from 162 down to 137, which is where we're tracking at the moment. So a little bit below where the forecasts were. We're forecast at 141, we're tracking at 137. So that part of the market's right. So now what's the next part of the recovery valuation in the market? And previously we've had PE expansion because of low interest rates, or interest rates falling. The probability of interest rates falling, I think, is relatively low, albeit we could see US earnings go into negative interest rate territory, but at the moment we're seeing the opposite. You're seeing the yield on the 10-year treasury move a little bit higher. So the relevance of that interest rate argument is that any growth in stock prices now really has to come from earnings growth, not PE expansion. So if we look at the $137 of earnings per share and backtrack, well, fair value for the S&P 500 was 2,500 points. But the market's saying, well, that's not where we're heading. Where we're heading is over the next 2 years, earnings are going to accelerate by over 40% from where we are at the moment. And by 2022, we're going to hit $196, which will be a new record high of average earnings per share for the S&P 500. Apply sort of a 22 to 24 times multiple, maybe even up to 25 times multiple, and you get an S&P index that's worth about 4,200 points, which is a good 10-15% higher than where it is at the moment based on this valuation. So that's the bullish argument for the market. Well, all we can do at the moment is watch this from a quarter by quarter basis. We're coming into fourth quarter earnings now in the US, where we'll see in early January what this December quarter earnings look like and how that's tracking, and that becomes an important factor in determining whether the optimism of the market, and this is not an issue for all stocks, but for certain stocks, where those PEs are extremely stretched, you're seeing sort of these historically high levels as, again, a reason for some caution, which is why we create that safety net. So the question just becomes, do we run with the herd, or are we going sort of against the herd, or looking for those opportunities in the market which maybe are a little bit counterintuitive to mainstream media? And that's something that we'll look at tonight. The returns of the algorithm model portfolios have been doing well. If you'd like to get the latest statistics on that emailed to you, please just drop me an email, leon@investorsignals.com, and I'll email you the latest returns on those algorithm model portfolios. With that, let's move into the first graph that we want to look at tonight, which is the NASDAQ. As I mentioned, if we zoom in and take a closer look at this, on Friday night we had a strong close there. We've shuffled the we've shuffled that sort of safety net up to a level, and just to give you an exact number there, it's roughly 12,361, but just think about it as, say, 12,350 thereabouts on the NASDAQ. But if we see a reversal back down through that, I'll just draw your attention to that on the blog. For the time being, we're continuing to make higher highs. It's above the 10-day average. The stochastic, whilst it's in the overbought range, that doesn't really create a strong sell signal. It's not until we actually saw more of a rollover and a break below the average and a break below that first safety net there. The other indexes that we just look at as a macro backdrop, the S&P 500, similar situation, continuing to make higher highs, strong close on Friday night and above the 10-day average. Stochastic still moving higher there. Our local market, a little bit different. Interestingly, we're seeing the stochastic here make a lower formation. We had a slightly softer close today. We gave back some of the early gains, and we'll move through some of these stocks that are of interest within the Australian market. So again, if you're joining us for the first time, generally what we'll do is spend one Monday night looking at specific watch lists, and then the alternative week we'll actually toggle through all ASX 100 stocks. We get through those in about 30 minutes, and I share with you the views and strategies on all top 100 companies. Tonight we're going to focus on the list. So the first thing we do is we click on the watch list. We come in here just as a reminder. So your custom lists is where you can plug in your own codes that you want to track there. Your scanned email list just gives you the current day's signals. So we're looking today, we had these three companies that we had algorithm signals on, and 2 buys and 1 sell. The other lists of relevance here, your recent signals. So if you've missed the signals over the last few days and you want to go back, this stores the last 7 days. So again, you could come in here, arrange this by percentage gain, maybe arrange it by buy, and you'd see the names that are currently under buy signals, and then obviously the ones there that switch to sell signals. What I tend to do is any of those that are of interest, I then use the feature to, so let's say I've clicked on, one specifically is Elders today I added to my watch list. So I clicked on that and then simply went add to list, added it to my custom list number 3, and then that just sticks that code in there. So any of those signals that are coming through on a daily basis that capture my attention, I plug them into one of those 3 watch lists, and then I'm able to toggle through them. For tonight's webinar, what I wanted to do first of all is look at our recent blog posts. So this list here stores the last 30 days of codes that have been tagged on the blog. So with that, let's click on that particular list, get the percentage gains to the top. We'll organize it in buy signals. So as I move through these are all going to be stocks that are under buys, and then at some point we move to ones that are under sell, and I'll just highlight to you when that shifts and the reason why I've included them on the blog, even though they may be under sell conditions. So the first one that we look at here is doTERRA Royalties. This was the spin-off of Iluka. So the yellow markers on the charts there just let you know that on that day we made a blog post. If you wanted to read what we said about the stock on that day, you can click on that yellow marker and it takes you through to the blog. So it opens a new web page and takes you through to the blog, and we're just highlighting here that the yield support for this set up for a good buying opportunity. We held this in portfolios. We still do in some cases. In others, we started to take profit around that $5 level, or $5.20 even, I think we got up to there. So that's been a strong performer, exposure to the iron ore play. So again, that's opened a new web page. We go back to sort of where we were. I'll just turn that trend line off. So now the idea of these toggle arrows is it allows us to move through the list. So what we're now doing is moving through the stocks that have been posted on the blog in the last 30 days. Domino Pizzas, we were buyers of this, so off the algorithm signal created the first alert there at around that $72 level. We created a channel there that highlighted an entry range. We actually did buy this, albeit only a small holding in portfolios, and in some cases we've already traded out of that, but you can go back and revisit the commentary there on the blog by clicking on those yellow tags. Cleanaway, this is a long-term buy and hold stock for the most part. We like the long-term thematics here. We want happy having exposure, especially in investor portfolios, to this name over the next 2 to 3 years. We see their continued movement into recycling and opportunities in Australia, which are strongly supported by government funding. As an area of growth that Cleanaway's likely to be one of the dominant players in. So buy signals originally back there at $1.40, again at $2.06, now making new highs. Altium's a new stock that I've just commented on the blog in the last few days. So this is a technology stock, trades on an extremely high PE multiple, but I've just highlighted support there at around that $34 level there. What we look at is the price is now back above the 10-day moving average. It is under algorithm buy conditions. The stochastic is moving higher. You just need to be careful with this being a high PE stock that you run a stop loss on a break lower there. But Altium's one that I flagged. Coles we continue to like, so just shuffling up the support level there. You can see there you've got a new consolidation range at around that $17.75. But continue to see in a low interest rate environment Coles pushing up towards at least that $18.50, $19 range. But you can sell covered calls up at sort of $18.50, $19, drive extra cash flow, and you're getting about 8 to 10% cash flow return from holding Coles. But we continue to like that, and I'm referencing that on the blog. Regis Resources, gold stocks maybe in the early stages are starting to find some support here at the moment. With the exception of Oceana Gold, which had a 30% rally today. But most of the gold stocks have kind of really sort of looked to be going through more of a consolidation phase. Appen, again, technology, trades on a high PE, highlighting early support there at $29. You could watch the stochastic for the fast line to cross back up through the slow line. I'll draw your attention to this on the blog. We've set a very small position in this as an early sort of entry opportunity, but it's certainly not a significant part of portfolios. but we'll continue to watch that, and I'll draw your attention to that on the blog. Now, Beach has been a stock that we have been long, so Beach, Woodside Petroleum, Origin, the Triple O ETF have all been ways that we've had exposure to the rally in oil. Still above the moving average, but it would feel for the moment that oil's getting fairly close to resistance, but we still like it as a 2021 story, and it's a buy on the dip opportunity, the energy name, so we'll revisit those on any pullback. Ramsay Healthcare, I think this is for a safe defensive inclusion for portfolios, so buying it here, selling covered calls. You're closer to the support, so you may buy this, let it rally a small amount, and then look to sell covered calls. But at around that $62 level, you're pretty close to support level there. Pro Medicus again trades on an extremely high PE multiple, but delivering 30% plus earnings growth and revenue growth, winning contracts among the largest US hospitals. So as a long-term growth opportunity, we can remain attracted to Pro Medicus, and we've kept it in portfolios. I just highlight that where we originally bought it back here at around this $24, rallied to 34, it's pulled back to 29. We've had another algorithm bias signal, stochastics pushing higher. For traders, you may just want to think about running a stop loss on a break below that 29, but the long-term fundamentals there still look attractive for Pro Medicus. Gold, let's zoom in some more data and have a look at what's going on here in Newcrest. So it's correcting from $40 down to 27. We still maybe just in the early stages of you're seeing gold actually start to rally. It's moved from about $17.80 an ounce back up to about, I think, $18.40 thereabouts, or certainly crossed $18.20 at least anyway, trading between that $18.20, $18.40 an ounce. The Aussie gold stocks haven't rallied generally too much in line with that, partly the strong Aussie dollar's been working against it, but it feels like we are in the early stages of sort of the beginning of a support level developing in these gold names. So a turn high, you might reference just simply looking for the price action to start to trade above that 10-day average, which is that line that I'm just highlighting. When I shift the mouse over there, you can see that red line or orange line there highlight. So you're looking for price action to cross back above that average. So Newcrest we like. Transurban, I think, although there's obviously risks with decreased traffic volumes both in Australia and on the US toll roads, Transurban's a stock you want to keep on your watch list. The band that I've created is fairly wide here, really say from $13 to say $13.80 as a support level. What we're looking for again is the price as a first reference is to see the stochastic turn higher, or to see the price action actually cross above the 10-day average. A little bit concerning. Utilities in general had a tough day today. We're seeing Transurban close on the session lows. For traders, you may run a stop loss on a break below this, but from a valuation standpoint, as we get down into that sort of 13 to 13.80 range, you're starting to get into a level where Transurban should represent good long-term value. REA Group, we just think this is a little expensive, so the last algorithm buy signal was there at 108. It's now travelled up to around 150. You'd want to be patient here, wait for a pullback, and we'll look at that on the next buy signal. APA Group, again, are utilities, which had a tough day today. I've spoken in detail about the next 6 or 12 months of earnings being a little bit soft due to cost overruns on one of their major projects. But coming into the December dividend, I think the number's about 23 cents. That's paid on the 30th of December. We should start to get a little bit of buying support, so just keep an eye on this one. Maybe down around that $10 level there, you start to see it cross higher in the stochastic, and there might be a buy on the dip opportunity there in APA Group, but we like the long-term fundamentals there. Gold Road Resources, I had the little rally there from 114 up to 130, coming back testing that support level, but we do feel that we're in the sort of early stages of gold finding support level. AusNet Services, so this created an algorithm buy signal there at around 180. Not a stock that we're too active in, but just drawing your attention to sort of the successful history. If we look back at the buy signals in the stock, have generally done a pretty good job of picking up the lows. The most recent one there at $1.60, and then obviously the current one that's been commented on the blog is that they're around that 180 level. So again, you could watch this, wait for the price action to cross above that 10-day average and run a stop loss below there, stochastic moving a little bit higher off that support level. A2 milk oversold where it is at the moment, but continues to be a tough environment for it to get buyer support at the moment. Getting down to a level where you're starting to see a number of analysts upgrade A2 milk to a buy. Bega we like this. We think this is fairly defensive even in a tough market. So somewhere around that 530 level, if we just look back at the recent breakout that the stock price had from say $5 up to 530, you may get a retest of that 510 level, which would be sort of filling that price gap. But Bega should be bouncing along support here, and we've seen the company upgrade their earnings outlook for the next 12 months. Sonic Healthcare now, I'm not sure if we're dealing with any company specific issues here or whether this is a combination of obviously the tighter restrictions in Europe and also the high Aussie dollar, given that Sonic has a lot of earnings in US dollars and in euros for that matter, which is adding to the selling pressure here. But ultimately, I think what you're looking at is a buying opportunity in the making here at Sonic. Whether you want to just be a little bit patient and wait for the algorithm buy signal at the moment, the last signal was kind of at lower levels. I would expect that we're probably somewhere down at around this $30 level, 30.70. We'll see a buy signal occur. We'll keep an eye on the stochastic starting to turn higher. But the correction that we've had from 38 back down to $30, Sonic's not going to deliver above average earnings growth. You're probably only going to see 2 to maybe 4% earnings growth, but it's an attractive defensive dividend yield, and there will be a point where it's some of the risk off sentiment builds in the market, the money will rotate back into some of these names that had been doing well. So buy on the dip there with Sonic, and you want to keep an eye on that. The same here with Fisher Paykel. So I've created a fairly wide band there of initial support at $30, probably sort of where I'd see primary support 28. So we're looking for some buying interest to build within that range at the moment. The stochastic's still pointing lower, but we'd be watching for a reversal there. If we go back to sort of where the initial sort of switch from the sell signal to the buy signal was in Fisher Paykel, it was around $14 that it was added into the model portfolio, and it's been a strong performing stock. But the company's delivering double-digit earnings growth, which remains attractive. So we see that as a buy on the dip. Ansell's another one. So Sonic, Fisher Paykel, Ansell, these are names that are now getting closer down to support level where you want to be thinking about taking action. We're starting to add these back into portfolios, especially in the trading portfolios where we've taken profits at higher levels. So in the case of Ansell, keep an eye on this sort of $33 level roughly. You're looking for maybe another maximum dollar of downside, and at around that $33 you'd be looking for sort of a key reversal, which would be confirmation that sort of the stock reverses off its session lows for the day. $33 looking for Ansell to find support there, and I'll continue to update you on the blog. Woolworths, now this is under sell conditions, so the difference, if we just backtrack, the primary signals here are buy, whereas we move to Woolworths and the primary signals are sell. So not very often will I talk about buying a stock that's under primary sell signals. In the case of Woolworths, what we're looking at here are these smaller interim signals, the red and green arrows. The green arrow here is pointing up just to show that we've got interim support there at around $36. From a fundamental standpoint, both Woolworths and Coles are growing earnings at high single digits, and in a low interest rate environment, money's going to continue to come into these names on any sell-off. So although there's not a lot of upside growth or upside potential here at the moment due to the high PE valuations, buying it on this support, letting it rally a little, selling covered calls, you're driving that 8 to 10% income. So if you'd like to talk more with me about that covered call strategy, just contact me in the office, and I'm happy to sort of walk through a couple of examples on how that can be utilized. The difference, especially when you're looking at the difference between, say, American and European options and the different strike prices and where to park those relative to the dividend period. So happy to work through that with you. So Woolworths we quite like off that support line at 37.50. Now the strategy that we've ran, and for those that have been listening to the webinars regularly, you'd know that our preferred banking exposure has been the BNKS, which is the Global Banks ETF, and we stay long that at the moment. We'll review that if we see a break lower in that Nasdaq and the S&P 500 index. But what that means for the Australian banks, they've had a similar percentage rally, so whether the investment was through the local banks or through that global BNKS, the returns have been pretty similar. Where we now sit at the moment is, let's have a look at this comment that I saved today from CNBC. So this is the head of Singapore's largest bank, and he's just referencing that the rising defaults and ultra low interest rates will be two major headwinds confronting banks next year. And that's really a reference to the global banking sector. So I think that highlights to us that it's not all clear sailing from here forward for the banks, and that optimistic picture that we looked at the beginning of the webinar, where we saw S&P earnings accelerating 40% over the next 2 years up to $196 of earnings, just tells us how much optimism is priced into this phase of the recovery in the market, which causes some, at least, reason to be cautious and continue to run that safety net under the indexes and be ready to de-risk portfolios where needed and add some hedging, and that'll obviously be a focus of the ongoing webinars and the blog posts. So in the case of the Aussie banks, CBA, expensive relative to peers, back up near resistance where it is here at the moment. If we saw the US indices break lower, we'd start to focus on the short side of the Aussie banks, but not doing that at present. Orica had been a stock, both Orica and Incitec pivot, and I'll spend more time looking at those next week. Macquarie Group up against resistance where it is at the moment. Again, not really on the short side of this unless you start to see those US equity markets break lower, and then there we are back to the beginning. So again, so for tonight what we've done is gone in, looked at the recent blog posts. What I'll do next is just look at the recent ASX signals. So this is the last 7 days of signals. So let's just have a look through these. So again, we get percentage gains to the top, the buyers, and from here this is really where the alerts come from for stocks to be added to my watch list, which then, after doing fundamental analysis on them, they then get added to commentary on the blog and included in either our models or our high conviction strategy. So GUD Holdings, so the first highlight here is that we've had a correction from $14 down to $11. It's under algorithm buy signal. It's not really a stock that's in sort of the spectrum of companies that I analyse too closely. AusNet Services, I touched on this one, now under algorithm buy signal there at around 183. Just as a reminder, on your software there, if you turn that little triangle from grey to green, and what that'll do is show Leon's charts, so you'll start to see the same lines on your graphs as I do on mine, or that I'm marking on mine. TNG, sometimes we have clients requesting small cap stocks to be added to our database. We're happy to do that, and these are not always companies that I'm covering closely, but just to comment on this one, it's switched to algorithm buy signals. It's below the moving average, but that's obviously the first part of starting to what might be a bullish reversal there, where you'd be looking for a close above that moving average, and the stochastic starting to move a little bit higher there. Elders, so this is an interesting one. I've created the channel here from around 920 up to say 980 as the support level. It's now switched to algorithm buy signals. The previous switch from sell up the top here to buy at the bottom at $6 proved to be a very strong performer, and then we've again got this higher low formation, and just a reminder that we're getting back into a buy range there on Elders, which is why I've added it to my watch list, and I'll revisit that on the blog in the coming days. BCI, so that its signal is a sell signal, not doing there at the moment. Vicinity, not really doing too much within the REIT sector at the moment. AMP, undersell, not doing there. Eden Innovations, not doing there. QIP, not doing there, undersell signals. Australian Ethical Investment Limited, not doing there, undersell signals. And there we are, back to GUD. The model portfolio area, so if we were to have a look, and I'll just use the top 20 as the example. So what we're doing now is we switch from watch list into model portfolio. This is our algorithm engine. If we want to know out of the top 20 stocks which companies are under algorithm buy conditions, here they are. The date that they were added into the model portfolio, the percentage gains, and the number of days that they've been held, and the dividends that have been accumulated since they've been in the model portfolio. You can go through and view the different model portfolios. If you want to ensure you get notified when a stock's added or removed from the model, just make sure you've clicked and that envelope's green, not grey. And then the trade table, just to touch on this again, what this is more for shorter term traders, and what we're looking at here is stocks within the top 20 that are under buy conditions, and the stocks within the top 20 that are under sell conditions. And then we've got two further filters being added. Out of those companies that are under current buy conditions, which ones have a positive pivot point, which is the interim green arrow pointing up, and now above the moving average. So interestingly, it's highlighting Newcrest, which kind of fits with our theory that gold's starting to get to a level where you really want to be starting to take a closer look at the opportunities there. One of the stocks that I've commented on the blog before, and we hold in some client portfolios, is Oceana Gold. We've seen the big rally there today in that, over 30%. So we are starting to see movement among those gold stocks, and the exact sort of timing of that. But if you're trading it, as long as Newcrest stays above the moving average, you could be long this stock now, and then if you were to see it switch, what you'd do is see that move to a red arrow, which would be a reminder that the stock's below the moving average. On the other side of the market, if we were to look at which stocks are under sell signals, which are breaking down and below the 10-day moving average, we start with CSL, Goodman Group, IAG, Telstra and Westpac. So we can see the negative ones there, you're looking for the double red arrows, and the positive ones you're looking for the double green arrows. Thank you for listening in to tonight. Again, next week we'll move back to focusing on the full ASX 100. Just as a final recap, the opportunities that are really sort of standing out at the moment, we continue to like TPG on this little sell-off here back to 750. A2 Milk we like, but we think that is obviously a high risk stop. Transurban, you should be starting to watch that pull back into the channel, and I'll continue to update you on the blog. Woolworths, Coles, those names, we continue to like those as buy rights. Ramsay Healthcare. ASX, I think this is one that you want to start keeping an eye on. It's getting back to 50% retracement of this current move. We know that the next 12 months trading volume is not going to be as good as the prior 12 months, but it is an attractive business, still potential of a takeover target at some point, and likely to be a strong sort of buy on the dip opportunity there, so great for investor portfolios, and we've started adding that back in. Stocks that are experiencing a little bit of selling pressure, as I said, a combination, a couple of things, lockdown overseas, high Aussie dollar, but I think Sonic Healthcare, you got to start thinking about that. Ansell, we need to start keeping an eye on that as it approaches that $33 level. Fisher Paykel, slightly higher PE, but still I think an attractive opportunity here where you want to be watching that as it gets down to maybe that $28 level there. Amcor, we continue to like this. Amcor Brambles, they're two defensive names that we like as buy right opportunities. And just to touch on a couple of those ETFs that we've looked at in prior weeks. So that Banks ETF weighted towards JP Morgan's done well. The Cure ETF that we continue to hold has performed well, which is exposure to biotech. The WDIV, which is the exposure to the global dividend fund, continues to do well. And the gold ETFs obviously haven't yet moved. So the with the miners ETF, at around that $6. So the broad exposure to global gold miners. The GDX, which is the Van Eyck Vector, is again around support there at 45. But whether you look at the ETFs or you focus more on so within those golds, just to think about the opportunities there of the ETFs, or the advantage of Saracen Minerals being taken over by or merging with Northern Star makes that an interesting sort of opportunity, because you've got the cost synergies there as well between Saracen and Northern Star, just as an added little safety net on top of whatever the gold prices do. One of the counter trend trades that we've taken profit on in most portfolios this week has been CIMIC. So we've had that rally there for buyers of this from around $20. It rallied over 30%. We've taken profit on that at the moment. We've taken profit on quite a few of the names that we've been long and started to really sort of trim down the exposure in portfolio, and now starting to lean that weighting back towards those those names where we've seen the correction in, such as Sonic, Ansell, Fisher Paykel, ASX, APA Group. So if you want to give me a call and run through sort of that strategy shift that we're seeing in portfolios, don't hesitate to call me on 1300 614 002. Thank you for listening in, and I look forward to speaking again next week.